For the last couple of years, it felt like the financial world literally only cared about one thing, the Magnificent Seven. It was this ultimate unstoppable investment theme of the AI revolution. But if we actually look at the data today, well, that era is pretty much over. That whole unified narrative is officially dead. And in its place, we're seeing the birth of a totally new, incredibly high-stakes reality. In this explainer, we're going to track the new Magnificent Four in this absolute landscape-altering capital expenditure cycle they've just unleashed. We're stepping away from the fluffy, narrative-driven AI hype, and we're going to uncover the rather brutal reality of massive balance sheet stress and collapsing moats. Let's figure out what's really going on here.
Okay, let's dive into the agenda for this explainer. We're going to cover how this leadership group decoupled, the mechanics of the Capex Trap, NVIDIA's hidden fragilities, a $2 trillion revenue chasm, some wild corporate zombie pivots, and finally, the macro fears that are currently trapping retail investors.
All right, part one, the Magnificent Four decouple.
To understand how the market's biggest unified front fractured, we have to start with an absolutely mind-bending figure, $670 billion. That is the combined 2026 capital expenditure guidance for just four companies: Amazon, Alphabet, Meta, and Microsoft. Apple and Tesla, they basically just opted out of this hyperscale trajectory, going for a more asset-light, on-device strategy. But those remaining four are running a $670 billion infrastructure sprint. To put that into perspective, these four tech companies are preparing to spend more on data centers than the entire gross domestic product of sovereign nations like Sweden or Argentina. What we're witnessing in real time is big tech rapidly mutating from highly profitable agile software giants into incredibly heavy capital-intensive utilities.
Now, what's really wild here is the sheer scale of this acceleration. Just take Amazon as an example. Their historical 5-year average Capex was hovering around $52.4 billion. But looking ahead to 2026, they are projected to drop $200 billion. Alphabet, Meta, and Microsoft are following that exact same aggressive, almost vertical curve. They're essentially trying to cram a decade's worth of infrastructure building into a tiny 36-month window. But naturally, this survival sprint comes at a massive cost. That $200 billion outlay for Amazon is actively devouring their free cash flow. Institutional models are projecting massive shortfalls for them, anywhere between $17 and $28 billion. The old big tech moat, that incredible advantage of zero marginal cost software, is just gone. It's been completely replaced by the brutal physical reality of having to constantly buy compute capacity.
Moving right along to Section 2, inside the Capex Trap.
So the Capex Trap is this nasty economic condition where a company is forced to continuously commit more and more of its cash just to maintain its current competitive position. Historically, there's actually a persistent asset growth anomaly where companies that aggressively expand their balance sheets end up severely underperforming their peers by about 8.4% a year. And a huge hidden part of this current trap is the completely bizarre mismatch between accounting assumptions and physical reality. On paper, these hyperscalers are claiming their AI servers will last 6 years. But the actual engineering reality, AI workloads create extreme thermal and electrical stress. It's literally like redlining a sports car 24/7. System architects note that these chips often survive only 1 to 2 years before physically melting down under the load. And even if they survive the heat, rapid architectural shifts like NVIDIA moving from their Blackwell chips to Rubin chips make that 3-year-old hardware economically obsolete almost overnight. So, you might be wondering, why on earth do they pretend these things last 6 years? Well, because it creates a massive temporary accounting illusion. Think about it. If a company takes $100 billion in capex and depreciates it over a realistic 3-year cycle, they take a $33.3 billion hit to their reported net income. But if you stretch that fantasy out to 6 years, the expense gets cut in half. That magically creates an artificial $16.7 billion cushion to their reported earnings. It's an absolutely brilliant corporate loophole. It artificially inflates their operating margins today, which keeps Wall Street happy while completely hiding the immense physical stress and obsolescence that is silently accumulating on their balance sheet for tomorrow. Which brings us to Section 3, the NVIDIA financing paradox. Now look, NVIDIA is obviously the undisputed king of this $670 billion spending spree. They're reporting an unbelievable 65% revenue jump, hitting over $215 billion for fiscal year 2026. But if you peel back the layers just a little bit, you start to see some serious fragility hiding inside those record numbers. Just 2 massive customers make up roughly 36% of NVIDIA's total data center revenue. It's basically a linear correlation between hyperscaler spending and NVIDIA's bottom line.
So if the magnificent force suddenly blink, maybe they run out of power, or their free cash flow drops too low, or they just decide to wait for the next generation of chips, NVIDIA's order book doesn't just experience a tiny dip, it hits an immediate, catastrophic air pocket. And this brings up the really strange, honestly kind of incestuous nature of AI vendor financing. If you track how the money actually moves here, it's fascinating. NVIDIA will make a massive, let's say, $100 million investment pledge into a company like OpenAI. OpenAI then turns around and uses that exact same cash to, well, buy chips from NVIDIA. NVIDIA also invests in specialized data centers like CoreWeave, who then use that capital to buy NVIDIA chips to sell the compute back to OpenAI. It is a completely circular ecosystem.
So we have to ask the hard question here. Are they actually incubating future customers, or just artificially propping up their own demand? Because if you're giving your customers the cash to buy your products, you're effectively selling those products at a massive discount. But crucially, and here's the magic trick again, you don't take a hit to your reported profit margins because corporate investments aren't factored into standard margin math. For the market history buffs out there, this draws a highly uncomfortable parallel to the aggressive vendor financing schemes of companies like Nortel, right before the dot-com bubble completely exploded in 2000.
All right, Section 4, the $2 trillion revenue chasm.
This is honestly the most brutal truth of this entire infrastructure sprint, the enormous monetization gap. Right now, current AI services are generating maybe $25 to $50 billion in direct annual revenue. But institutional research from the folks at JP Morgan and Morningstar shows that to get even a modest 10% return on this massive physical build-out by 2030, the industry needs to generate roughly $2 trillion annually. $2 trillion. They literally need a 40 to 100-fold multiplier in just a few short years. These hyperscalers are locked in a classic prisoner's dilemma. The smart, rational move for all of them would be to coordinate, slow down, and preserve their massive profit margins. But the absolute terror of being left behind forces every single one of them to overspend, potentially destroying their collective profit pools just for the right to stay in the race.
And hitting that $2 trillion goal, that means fighting impossible physical constraints. We aren't just bound by code anymore, we are bound by literal steel and copper. AI data center construction costs have skyrocketed past $20 million per megawatt. We are seeing absurd 16 to 22-month waiting periods just to get basic electrical switchgears delivered. And the energy bottleneck is honestly terrifying. Microsoft alone needs a 600% surge in electricity by 2030. That's forcing them to sign massive, unprecedented nuclear power deals just to guarantee baseload energy. Add in structural geopolitical oil risks pushing premiums up by $10 to $20 a barrel, and the physical act of building this AI future is colliding head-on with hard macroeconomic reality.
Section 5, zombie pivots and energy shocks.
While all this massive capital sloshes around the top of the market, the deeply speculative, frankly absurd side of the market wakes up at the bottom. Enter the Allbirds warning. So Allbirds was a company famous for making eco-conscious, sustainable wool shoes. Over time, their stock dropped about 99%. So what exactly is a failing shoe company supposed to do? Well, they sell off their intellectual property for pennies, completely abandon footwear entirely, and announce a sudden pivot to GPU as a service. Yes, you heard that right. From sustainable wool shoes to leasing AI compute capacity. They had absolutely zero AI engineering talent on staff, but simply filing the SEC paperwork, heavily padded with magic keywords like compute infrastructure, triggered automated algorithmic trading bots, sending the stock up an incredible 582% in a single trading day. It is pure, unfiltered corporate alchemy. Let's walk through how this actually plays out, because the life cycle of these zombie pivots is incredibly violent and shockingly short. In the first 4 hours, high-frequency algorithms trigger off those AI buzzwords in the press releases, aggressively spiking the stock price and really thin volume. By hours 12 to 24, the narrative hits social media. Everyday retail investors get severe FOMO, driving trading volumes through the roof in what we call the meme phase. But between hours 24 and 72, the trap snaps entirely shut. Insiders and early algorithmic whales use that retail frenzy as exit liquidity, dumping their heavily inflated shares at a massive profit. The retail buyer is ultimately left holding a hollow shell company, burdened with a small credit line to buy GPUs while absurdly trying to compete with Amazon's $200 billion war chest. And that leads right into Section 6, the retail liquidity trap.
There is this profound, almost tragic disconnect in the market right now. Institutional managers, the so-called smart money, are staring very closely at that $2 trillion revenue chasm. They see the free cash flow erosion, they see the physically melting hardware, and their confidence index has absolutely plummeted. They're demanding proof of actual real-world cash flow, and they are quietly packing their bags, rotating out of AI builders into boring, value-defensive sectors. But retail investors? They are doing the exact opposite. They are exhibiting deeply pro-cyclical behavior, literally doubling their capital injection rates compared to the 5-year average. They are desperately trying to buy every single dip, swept up entirely in this utopian AI narrative. So the big question is, why? Why is retail running directly into the fire? Well, actuarial data gives us a sobering, deeply human answer: longevity risk. A 65-year-old today has a 40% probability of outliving a standard 20-year investment portfolio. Over the last few decades, our financial system completely shifted the burden from defined pensions to self-funded retirements. Now, the terrifying mathematical reality of falling into a late-life portfolio black hole is actively driving this behavior. With stubborn inflation eating away at purchasing power and healthcare costs compounding aggressively year over year, a traditionally safe 4% withdrawal rate just isn't cutting it anymore. People are simply terrified of running out of money before they die, and that makes them incredibly vulnerable to taking massive, speculative risks on AI stocks that promise some miraculous high-yield way out.
And that brings us full circle. The Magnificent Four are locked in this desperate survival sprint, betting $670 billion on hardware that is literally melting in their data centers, while masking the multi-year margin compression pain with some very clever accounting extensions. Meanwhile, everyday retail investors are funding the frenzy out of deep retirement fears, while the institutional heavyweights quietly back away toward the exits. The tracks for the next century of intelligence are absolutely being laid right now, shifting the entire tech landscape from high-margin software moats to heavy, physical utility infrastructure. But we have to leave you with this question. Can Magnificent Four actually bridge a $2 trillion revenue chasm before their hardware physically expires? And if the math ultimately doesn't work out, who is going to pay the bill? Thanks so much for joining me for this explainer. Keep questioning the data, and we'll catch you next time.